Good afternoon. I hope everyone is doing well considering the circumstances of the pandemic. First of all, we want to sincerely thank you for your time and welcome you to today's webinar hosted by the Retirement Advantage. This is the second installment from our Secure Act webinar series, and today we will be discussing MEPs to PEPs and more, what advisors need to know. My name is Bill Sunigal. I'm the Marketing and Communications Director for the Retirement Advantage. Today's presenter is Trey Galuppi, TRA's MEPs Specialist. At TRA, we're excited about the expanded opportunities that the Secure Act will bring to retirement plan sponsors and advisors, and we can't think of a better person more qualified to explain these opportunities than Trey. Trey is a retirement plan subject matter expert and valued consultative resource for advisors and plan sponsors. Trey joined TRA at the beginning of 2020 and is primarily responsible for working with TRA's regional sales consultants, focusing on the overall expansion of the firm's consulting capabilities in the areas of group sponsor plans. This will include MEPs, PEOs, PEPs, MEPs, and producer group organizations in an effort to align these plans with record-keeping partners and distribution organizations that leverage TRA services. Trey has spent the past 10 years in plan administration, product development, and retirement plan sales. Before he joined TRA, Trey built his MEP plan background working with several retirement plan industry leaders. We'll now segue over to Trey to go over the agenda as well as the different type of plans impacted by the Secure Act. Trey?
Thank you very much, Bill. I really appreciate it. And thank you, everybody, for joining us here. As we start looking a little bit at today's topics and what we'll be discussing on this, we're first just going to spend a few minutes discussing why TRA, the Retirement Advantage here, and a little bit more about what we do on this side. From a groups plan perspective, we're going to be focusing our intent here on multiple employer plans, known as MEPs, pooled employer plans, known as the PEPs, and aggregation plans. We're also going to be spending a little bit of time discussing some of the suitability in these different models here and discussing which application will be right for which clients to be able to help you as the advisor be able to maintain a proper level of advisory relationships with your clients to steer them in the right direction so that they can have a successful plan for their business and for their employees. So as we get into this, I wanted to spend just a moment discussing why choose the Retirement Advantage. And really, there is a few reasons in here that we'll spend just a few moments on, but the Retirement Advantage is going to be a very important strategic retirement plan partner for you. And the ideas that we're trying to convey here is that you as the advisor can count on TRA to create customized solutions for your retirement plan clients. Also to share our deep retirement plan experience with you to ensure the mutual business growth and provide a seamless client service experience overall. As we take a look at TRA at a glance, just to understand our organization a little bit better, we have plans across all 50 states in here and have been doing administration for retirement plans for over 24 years. Currently, we're at a little bit over $8.5 billion in assets under management, with an entire base of employees and experts over here that's nearly at 200 already. We currently work with about 8,500 different plan sponsors throughout the country, and we employ 15 different regional sales consultant reps across the state or across the country. So as we get into our presentation in here, I did want to thank everybody for taking the time and joining our webinar. And today we are going to be focusing on the three main types of group 401k plans, consisting of multiple employer plans, commonly referred to as MEPs, pooled employer plans, known as PEPs, and aggregation plans. We'll be discussing the structure of each of these plans and how they're sponsored and who can sponsor each type of plan, as well as provide some insights for the suitability in each plan type by exploring some of the advantages and potential disadvantages for each of these plans. So before we get started, I did want to spend a moment just understanding some of the glossary of terms in here that you guys will hear throughout the presentation, and spend a little bit of time knowing these acronyms and being a little bit more familiar with those as we dive into the presentation. As I mentioned before, MEPs is the acronym for multiple employer plans. These were formerly known as closed MEPs. That is what we're going to be focusing on in today's presentation. The PEPs are the newest addition in here through Secure Act from December in 2019. These are pooled employer plans. And then we'll also be discussing the sponsor of these pooled employer plans, or PEPs, which is known as a PPP, or Pooled Plan Provider. You will also hear me use the terminology of PEO. This stands for Professional Employer Organization. These are HR-related entities that provide services on behalf of the employer clients that they have and operate as the employer of record. Those services can range from various benefits to payroll, workers' comp, and certainly into 401k. We'll also be discussing a little bit of open multiple employer plans. These are types of plans that operate in the same capacity as a closed multiple employer plan, with the exception that individual Form 5500s are filed on behalf of each adopting employer. Okay, so let's dive into our presentation here. As I had mentioned earlier, our focus today is on the three main types of group retirement plans available: multiple employer plans, pooled employer plans, and aggregation plans. To better understand the basic structure of each of these plan types, it's important to first recognize the fundamental traits of each plan type. A multiple employer plan, or MEP, is a 401k plan that is sponsored by an appropriate entity, such as an association or professional employer organization, PEO, which allows various employers to band together to create one large 401k plan. Prior to the Secure Act being passed on December 20th of last year, these plans were often referred to as closed MEPs, and they have a single Form 5500, which is filed covering and identifying all of the adopting employers inside of the plan. Additionally, these plans provide for a centralized plan administrator, plan trustee, and plan sponsor. Multiple employer plans also require a business nexus to exist that is achieved generally through a bona fide trade association or professional employer organization, and of course, businesses that are owned under common ownership there. The pooled employer plans are the newest type of plan under the Secure Act and are intended to operate under the regulations of a multiple employer plan, with the fundamental differences that a pooled employer plan, or PEP, is that these types of plans must be sponsored by what the Secure Act identifies as a pooled plan provider, or PPP. Now, the full details for registering as a PPP are expected to be released at a later time this year. Other notable differences between the multiple employer plan and the pooled employer plans is that no business nexus is required for the PEP plans. So in other words, unrelated employers would have the opportunity to band together to create effectively scale, reducing the administration, mitigating the liability, and potentially minimizing the cost for all of the adopting employers inside of that PEP. The PPP may also file a combined 5500 as the multiple employer plan sponsor does, or at least under current interpretations of the Secure Act, may elect to file separate 5500s for each adopting employer of the PEP. Aggregation plans operate in a different capacity than the MEPs or the PEPs, in that adopting employers of an aggregation plan will serve as the respective plan sponsor, and individual Form 5500s are filed for each adopting employer. However, inside of an aggregation plan model, there are other fiduciary roles that are centralized, allowing fiduciary relief to the adopting employer. As a result of the individual 5500 filing and the absence of a centralized plan sponsor, there is no business nexus requirement for an employer to adopt this type of plan. Okay, so let's take a closer look here at each of these models separately, beginning with the multiple employer plans. Again, as a reminder, when we're speaking about multiple employer plans, it should be implied that these are in reference to closed multiple employer plans, unless otherwise stated. So who is able to sponsor and offer these types of plans? Under ERISA, the main types of entities permitted to sponsor and offer a MEP plan are professional employer organizations, PEOs, because of the co-employment arrangement, as the PEO is considered the employer of record and files the PEO under the PEO's tax ID number. Bona fide trade associations are also permitted to provide multiple employer plan arrangements for their members, and businesses that are under the common ownership. Our focus for this webinar will really rely more on the first two, the bona fide trade associations and the PEOs. To reiterate, multiple employer plans file as a single plan under ERISA, single Form 5500, which is required to identify and name each adopting employer and provide an estimated percentage of total assets each adopting employer retains. So what do these roles and responsibilities look like under a MEP plan? As you can see on this slide, in a single employer plan arrangement, the plan sponsor or business owner has liabilities and responsibilities associated with several different fiduciary roles, mainly identified as a plan sponsor, administrator, investment manager, and plan trustee. It's important to point out that while many plan sponsors may have already elected to outsource these roles to other service providers, they are in most cases still liable for the work and the oversight that these service providers perform. Upon choosing to join or adopt a multiple employer plan, the single employer plan sponsor has effectively transferred the responsibilities and liabilities associated with these fiduciary roles to the MEP. At this point, the employer effectively becomes what is known as an adopting employer, which makes him or her free to focus on their business objectives without the burden of maintaining all aspects of compliancy associated with administering and sponsoring a plan for their employees. So what does a pooled employer plan structure look like? For the most part, a pooled employer plan will operate under the same requirements that a multiple employer plan does, with a few notable differences. First, the PEP plans will not require any type of business nexus and may be offered to employers across multiple industries and of varying shapes and sizes. PEP plans will also receive some audit requirement relief, whereas in multiple employer plans and single employer plan arrangements, as well as aggregation plans, the audit requirement of 100 or more eligible employees stated on the Form 5500 will be required to conduct an outside audit, subject to the 8120 rule if applicable. The pooled employer plans will not be required to conduct an audit as long as two conditions are met. Firstly, no single adopting employer has more than 100 eligible participants, and secondly, that the combined number of eligible participants across the entire PEP plan does not exceed 1,000. Additionally, all PEPs will be offered and sponsored by a pooled plan provider. A common question to this statement would be, what is the difference between a pooled plan provider for a PEP and a plan sponsor of a MEP? And the simple answer here is that a pooled plan provider would be a service provider of the plan and would be required to register with the Department of Labor and IRS as such. The specific requirements for a PPP is expected to be released in the Treasury regs and is anticipated to happen later this year. Some other differences between these two types of plans and their sponsors or providers will be addressed a little bit later as we cover the suitability and marketing aspects of these types of plans. Similar to the MEP model, the roles and responsibilities for a single employer plan sponsor would remain the same, as the named fiduciary assignments as plan sponsor, plan administrator, investment manager, and plan trustee. Again, to reiterate, even though the plan sponsor of a single employer plan may have hired other entities or service providers to perform the task associated with these roles, they are still responsible for the work and the oversight of services that are being done for his or her plan. So as we see, similar to the single employer plan sponsor adopting a MEP plan, the single employer plan sponsor here would effectively also become an adopting employer of a pooled employer plan or PEP, and upon joining would have transferred those roles and responsibilities associated with being a plan sponsor, plan trustee, plan administrator, as well as a plan investment manager. So now let's take a closer look at the structure and the functionality of aggregation plans. Unlike the MEPs and PEPs, aggregation plans do not have a centralized plan sponsor and do not file a single 5500 as individual Form 5500s are filed for each adopting employer. These types of plans, however, do have a centralized named plan administrator, a fund menu, and a plan investment provider. Also similar to the MEPs and PEPs, these plans can utilize a centralized record keeper as well as a centralized third-party administrator. Like the aforementioned PEP plans, aggregation plans may be adopted by multiple unrelated employers. Adopting of aggregation plan will serve as their independent plans, adopters of the aggregation plans will serve as their independent plan sponsors, but will mitigate a large portion of their fiduciary liabilities as plan administrator, identified in sections 316 of ERISA, as well as fund management fiduciaries, which are identified in ERISA under sections 321 and or 338. As we explore the levels of control a client has accessibility into these group plan types, this slide is really intended to illustrate the varying levels of control that each plan type will exemplify. The order of these plans that are on the screen is based on the assumed size and scope of the plan. The PEP plans would be controlled and marketed by the pooled plan provider and would carry the highest amount of responsibility, as PEP plans are capable of covering a larger group of employers since no business nexus is required. The MEP plans are listed below this type of plan, as a sponsor of a MEP plan is responsible for more of a limited group of employers or members of a specific group, such as a PEO or a trade association. The plan that would be marketed and designed for that specific type of group, whereas the aggregation plans here can be custom designed for a specific group to endorse or market without the endorser being required to retain any type of fiduciary role, as each adopter of the plan would serve as their respective plan sponsor. So let's take a look and spend some time here to help answer some of the tougher questions that most of you will end up being asked, which is going to pertain to how to determine which type of plan platform is right for which type of clients. To first understand how to make this determination, a few key questions should be asked. It is very important here to differentiate between the type of roles that a particular client is considering. Are they considering being a plan sponsor or an endorser, or are they considering adopting a plan as an adopting employer? So when discussing plan type suitability for clients interested in sponsoring or endorsing a plan, the three main questions that would be asked would look like, what level of control, responsibility, and involvement does the client want? What does the client want the plan to accomplish? And lastly, who does the client want to offer the plan to? When we look to discuss plan type suitability for clients interested in adopting a plan for their employees, the three main questions to ask here would look similar, but are slightly different. The first question actually is going to be the same. What level of control and responsibility and involvement does the client want? And then what type of plan and design does the client currently have? Meaning, is this a defined benefit plan or cash balance plan? Or do they even have a self-directed brokerage account attached to their plan? And lastly, what are the client's top priorities for the plan? This question would be to understand if pricing is the most important function, or retaining a specific fund arrangement or service provider, or any other top priorities that the client may have, as these components and these answers will play a factor in the determination for suitability. Pending a client's answers to these questions will provide a more refined understanding of suitability. For example, if a client's objective for offering a plan is to increase and retain membership for their association, as well as provide a marketing strategy to elevate their benefit offerings to members, the most suitable solutions would be between a multiple employer plan and an aggregation plan. Likewise, if a client had indicated that they have a defined benefit plan or cash balance plan, as opposed to a defined contribution plan, then a pooled employer plan arrangement would not be suitable, as these plans are not available for these types of platforms, at least not initially. However, should a client with a sponsoring objective be to provide a complete 401k solution that has competitive pricing, as well as an ease of implementation with a wider range of versatility, and is intended to be offered across various unrelated employers, such as a payroll company or focus group, then an aggregation plan may be the most suitable platform to consider due to the flexibilities available in this type of plan. This slide is intended to serve as a basic outlay of some of the key components for each of the plan types in discussion for both sponsoring and endorsing perspectives of clients, as well as potential adopting employers. Here are some more examples of the suitability as they relate to plan sponsors. However, when considering suitability for adopting employer clients, there is no such thing here as one-size-fits-all plans. Several factors need to be taken into consideration on the selection of which plan type is going to be best for which potential adopter. These factors will range, but as we saw in our previous slide here, scale is an example of something that can be found here within each of the three groups. However, there is different varieties and different levels of scale. As you can see from this slide here, the different varying levels of scale attainable under each plan. While price really should not be the most important factor of deciding a plan, it is certainly a very prominent concept to consider when choosing a plan to offer to employees. A fund lineup experience, the experience of the service providers that are facilitating various aspects of the plan, the administration, the management, all of these aspects and service providers are equally as important for consideration. So as we look at some of the potential examples of suitability, there may be some variations to these examples based on a particular client's answers to those previous questions that were asked. However, in common and more traditional understandings of these various types of entities and the potential matching groups that we associated them with would probably be the most appropriate fit. For medical trade associations, the group plan that matches up more commonly here would be a closed multiple employer plan. This would be due to the size and marketing applications for this type of plan, as well as the scale that is achievable under associations of this type. Chamber of Commerce is a little more tricky of an example, as these groups often range in size and members. Likewise, the committees who run these chambers often have varying levels of their involvement as well. The match that you will see for this type of plan was an aggregation plan. This was selected due to the flexibilities of membership to avoid any ambiguity here between associations' bylaws identifying full members versus associated members, or bona fide status, clarity aspects, etc. Additionally, by removing the fiduciary responsibilities from an endorsing entity for a chamber group, the aggregation plan would effectively be a suitable fit for this type of plan. However, solid arguments can be made for these types of groups to be better matched with a multiple employer plan or even an open multiple employer plan. A payroll company does not have the same business nexus that a PEO would have, as the payroll group is not the employer of record for tax filing purposes, but would be handling the file submissions for larger groups of otherwise unrelated employers. Payroll companies tend to find the aggregation plan the best type of fit due to the ability to provide a more centralized plan offering that allows adopters to still design specific plan provisions for their plans, such as safe harbor designs, vesting schedules that vary, and/or eligibility requirements, as aggregation plans are structured to accommodate a wide variety of plan designs. Additionally, aggregation plans may provide for some administrative work relief for the payroll company, who would only have to communicate with a single TPA and record-keeping system without being required to retain a fiduciary role. When looking at larger purchase organization entities, such as hedge fund groups or private equity firms, a PEP solution may be the most suitable for these types of plans, as they can be designed to accommodate a much larger scope of clients and can be set up specific to the PPP's business objectives. Centralization, control, and scale would effectively become the most pivotal points for these types of potential sponsoring entities. Again, because I had mentioned that there really is not a one-size-fits-all approach to these types of plans, the selection of a particular plan type And as you've seen throughout this presentation, several factors are going to play a role in both the selection and adoption of a plan for both sponsoring as well as partnering and choosing which plan to adopt for your employment. Partnering with the right TPA firm can not only help to safeguard your client's legal responsibilities, but can be instrumental to ensure the plan's success, allowing your clients to not just set their retirement goals, but to achieve them. So why choose TRA as your third-party administrator? Because in today's complex regulatory environment, it is more important now than ever to choose the right TPA partner. And by partnering with the Retirement Advantage's team of experts, together we can help your clients and their participants navigate through the complexities of the Secure Act, as well as future regulations, to effectively and compliantly connect your clients with their goals. I encourage all of you to reach out to your regional sales consultant to learn more about the support and service that TRA provides, giving you, the advisor, the competitive edge in this ever-changing market. Thank you all very much for taking the time here to log in and download and listen to our webinar. At this time, we would like to open this up for any questions that would like to come through, and feel free to contact us through the numbers that are on your screen to be able to ask those questions. And I can assure you we will get everybody's question answered individually and respectfully here. You can see that the main number here to contact your regional sales consultant is on the screen at 888-872-2364, or you can simply log on to our main website at tra401k.com. You can also reach out to myself directly. My number is on the screen as well. My direct number is 954-637-1270, or you can reach me on my cell phone, which is 954-821-2007. And my email address is also a fantastic way of getting a hold of me at any time at Trey Galuppi at tra401k.com. And that is Trey.Galuppi, Galuppi, at tra401k.com. So that is all the time we have for today, but please look forward to our future webinars, and we look forward to helping you all achieve a successful and sustainable business future for a long time. Thank you again on behalf of the Retirement Advantage, and please have an enjoyable rest of your week.